Are you a first-time investor or a first-time home buyer? Have you ever thought what would be more difficult to buy your first investment property or your first home? I think you'll be pleasantly surprised that one of these options is substantially easier to achieve when you're trying to do it for the first time. So guys, this week I'm going to talk about buying your first investment property versus your first primary residence, and how one can be a lot easier the very first time. These typically are meant for single family residents up to 4 units. So you can actually have a quadplex, a triplex, a duplex. There are some lenders out there that'll let you go up to 8 units. But these are typically going to be for your first initial investment or buying individual properties to add to your portfolio. Because the process of buying your first home for yourself is a lot more difficult than it is to buy your first investment property. And you're probably saying, why is that? Everyone's talking about we want people to buy their first home. Let me go through 4 things that actually happen out of the chute that you have to worry about as a first-time home buyer for your primary residence. 1, got to get your credit pulled. 2, you have to supply all your personal documents, which are consistent of tax returns, W-2, pay stubs, bank statements, any other type of debt that you have that shows up on your credit bureau that you have any challenges with. Number 3, you have to qualify off of your personal income and your debt to income ratio. And number 4, if any of those things have challenges, then you actually have to explain why those items, let's say you had a late payment, several late payments on debt that went to collections, but you've resolved it, you've taken care of it. You have to write your loan officer or whoever you're working with has to write an explanation, a letter of explanation to the underwriter explaining that. And then, oh, by the way, in all of this, and this is same across the board for DSCR investment properties, you have to have down payment and you have to have closing costs. And then you have inspection fee, I should say, and an appraisal fee. All the same for those 2 loans. But after everything's said and done, wouldn't you like to be able just to buy a property that actually qualifies on its own? All you have to do is show up with 2 things: your credit and the down payment and closing costs. That's it. You don't need to show any other documents that are personal. Now, if you're closing in an LLC, you're going to have the operating agreement. You're going to have a bank statement. You can use your personal bank or your business bank account, but you're going to have 60 days worth of bank statements and have enough in there to cover the closing costs and also your down payment. And then everything else is very simple. The one other step that's actually identical to buying your first property is you got to get an appraisal. The property has to appraise. And during that appraisal, the appraiser is going to actually do a schedule of rents. And that's how your property is going to qualify based upon the rents, the market rents. If it is vacant, I should say. If it's currently occupied, they will take the current rents that it's producing and give you a debt service coverage ratio. And that typically will need to be above 1. Now let's talk about the DSCR ratio. People are out there, and I say people, other loan officers, other people that are in the space, they talk about, oh, don't worry about it. If your DSCR ratio is below 1, I've got a lender that'll take care of you, no problem. So let me back that up and let me tell you this. If you have a DSCR ratio at 1, you're losing money. And you're like saying, Ryan, what are you talking about? That ratio will only cover your PITI, which is principal, interest, taxes, and insurance. It won't cover any type of maintenance reserves. It won't take care of your property management if you're paying a property manager. It is not going to cash flow for you. So you could potentially be negative cash flow right out of the chute after you pay everything. So why would you want to buy a property that's negative cash flow with a 1.0 DSCR ratio? I wouldn't, and I'm highly suggesting you don't either. I have seen some pretty bad deals in my time to where the DSCR ratio was 0.7 and 0.5, which means it's barely covering 50% of the PITI. And you got all the other expenses. Why are you so desperate to get into a investment property that you're losing money on right out of the chute? So guys, you need to figure out what the DSCR ratio is. And if your broker, lender can't help you with that, reach out to me. I'll help you. It's very simple. The calculation is just that. What are your expenses? What is your rental income? You'll get a ratio. If that ratio is less than 1 or at 1, you're in trouble. Run. Or can you raise rents if it's on a month to month to where you can get a substantial increase within law, of course, to be able to cover your costs, but also start cash flowing. The sweet spot that I found in doing over 65 of these in the last 12 months on a low end of 1.25 and right around 1.35, 1.4, that's really a sweet spot to where on a property, and I do a lot of properties that are 100, 120,000. So this is what I'm using for an example. If you're in a higher end market, then it's going to be a little bit different. But for a property that's at $100 to $120,000, they're making $1,200, $1,300, $1,400 a month in rent. They're cash flowing after all the bills are paid, the property management's paid. They're putting some reserves away for any type of repairs, maintenance. They're cash flowing about $236 a month. Not very much, is it? It's roughly $2,600 a year, $2,700 a year, right around there. Not much. So can you imagine if you actually had a DSCR ratio of 1, or how about less, 0.5, 0.7? You'd be losing money. You're a first-time home buyer. You're a first-time investor. I'm not going to try to convince you either way. I'm just going to lay out the facts. You need to figure out, what does the first-time home buyer program look like and what you will require to show and be able to prove, and can you prove that information to make the actual loan work for you? If that loan is going to stress you out and cause you financial worry, then you need to look at a DSCR loan and get your first investment property. You want to put your money to work. You don't want it sitting on the sideline. Yes, you're paying somebody else's mortgage right now with renting, but guess what? You can start building a portfolio of rental properties through DSCR loans. Once you put your first deal on the table, it's closed and funded, lenders then see you as a less of a risk, and you're going to get a better rate, better terms. You're going to have less of a prepayment penalty potentially. There's a lot of different benefits. The down payment is going to be the same, typically between 10 and 20%. Your closing costs are going to be anywhere between 5 and 7%. So realistically, earmark 30% for closing costs on a DSCR, and you don't have to worry about supplying all your personal information. As long as the property is cash flowing, if it's not 1.25 or higher, you need to run and say, no, this is not my deal. You got to make those smart decisions. But back to the difference between first-time home buyer and first-time investor, it's a lot easier to actually get into that property as an investment than it is as a first-time home buyer. Now, am I asking you to make a decision on whether to be a first-time home buyer or a first-time investor? No. Am I biased to first-time investors? Yes. I also, on our real estate side, I help out with first-time home buyers. So in the end, I like both. But I also want to be able to educate you on the differences of the two. Now, don't get me wrong. There are downsides on DSCR loans. Let's talk about them, and we'll wrap up. 1, prepayment penalties. They do exist. The longer the prepayment penalty, the better rate you're going to get. If there's no prepayment penalty, higher rate. It is going to be somewhere in between 25 and 75 basis points. That's 0.25 to 0.75 higher than what you would get with a prepayment penalty. With the DSCR loan, you're personally guaranteeing it. So God forbid if something happens and the mortgage doesn't get paid, the lender will come after you. It's identical to owning a home. It goes through a foreclosure process, and then they figure out if they're going to do any type of subrogation or any type of loss mitigation. Same concept. You're on the hook for both, so there's no difference there. The other downside of DSCR loans is you're a landlord. Do you want to be a landlord? If you want to be a landlord, you're starting to put yourself in a place of financial security. Start in your own backyard. Start in your backyard to where you can touch and feel the properties that you're looking at. Find somebody that you can vet that can do property management if you don't feel like you have the skill set to do it. Vet them out. Get all your questions in your concerns on the table to make sure that you know what you're getting into before you sign on the dotted line, because they're going to take anywhere between 7 and 10% of the rent every single month. So be cautious of that. And the last thing, on the DSCR loans, it's identical to anything else. Read the fine print before you sign on the dotted line. Read the fine print before you sign on the dotted line. As a DSCR investor, do the exact same thing. Read all the closing documents. If you have questions, you've got to ask. Don't sign it and then arbitrarily think everything is going to be fine. They put together those documents for a reason, to protect them, the lender, not you. So you have to make sure that you understand what you're signing up for. So guys, I hope you enjoyed this week's video comparison of first-time home buying, first-time investor. I hope this video helped you out. If you like what I'm putting out, please subscribe, share, and comment. We're building a community, and we'd love for you to be part of it. Stay safe, stay healthy. I'll see you guys on the other side.